Hello everybody, the Swing Trading Club here. We have another rough week behind us. We're going to get into what actually happened with the Federal Reserve interest rate increase. That was 75 basis points on Wednesday. We're going to get into how the markets played that, what to look for in the future in terms of where to position yourself, and a whole lot more, so stick with us. The first thing to knock out is, of course, just that they did, in fact, hike 75 basis points. This is their largest since 1994. Now, what does that actually mean? It's a little bit decoupled from, a typical mortgage or an auto loan or a credit card loan, right? Everything is based off more or less the federal funds rate. Now, the federal funds rate is just an overnight rate that banks pay back and forth to borrow money. So it's kind of like if you think of a house and you have a bunch of different rooms in your house. This is kind of a strange analogy, but the plumbing is what the 75 basis points is. So it's the plumbing for the economy, right? It's how do we move water throughout the house, and then the different rooms in the house are, the mortgage industry, the auto insurance industry. Again, kind of a strange analogy there, but that's kind of how you want to think of it. The Fed funds rate is the foundation to where everything else is built off. So when somebody, in this case Jerome Powell, the Fed chairman, and they're the only ones that have the ability to do this, when they increase that rate, money's going to become more expensive for the banks to borrow back and forth, and it sends ripples throughout the entire economy. So that's kind of a quick little synopsis of how that move actually occurred. Now, I did go through and watch the entire press conference from Jerome Powell. He does a probably 30-minute just kind of summary of the Fed's findings and, expectations for the future, and then he opens it up for questions. Questions are typically where you'll get a lot more insight than his actual prepared remarks, but they are good to go, and you can, stream them pretty easily through any major news network. But they're interesting to watch. A lot of his comments were, pretty hawkish, really. He's, at least according to him, dead set on battling inflation. He still cites strong job numbers, and he's really going to be, at least again from what it sounded like in the press conference, very committed to lowering the inflation over the next, really till 2024 is kind of what he outlined. Now, they did say they're not expecting to have another 75-point hike. That was more of an anomaly based on the indicators that we received coming up from prior to the meeting. So it's going to be interesting to see where we go from here, how the CPI number is actually impacted, but we're going to get into all that. But before we do, I want to quickly hop over to some other comments that we found on the Wall Street Journal. And this is just another governor, Christopher Waller of the Fed, but he said he's actually in support of this, an additional 75 points next month. And so I think it's going to be interesting to see how that dynamic plays out, and kind of where we are set for next month. And it's really going to depend on that data in the interim. So we'll see where that all ends up, but we'll keep discussing. But that's kind of the main topic, at least of last week, was this huge increase. So as mentioned in our introduction, I wanted to quickly also focus on some of these additional economic releases besides just the 75-point hike that we just discussed. So U.S. import and export price indexes. Now this is something to just kind of pay attention to, and all these things, guys, are all outlined in the Bureau of Labor Statistics, just BLS.gov. They put these out usually monthly, and so this latest report just came out last week, so we're going to highlight it quickly. And the only thing I want to talk about, we'll just kind of do a high level. We don't need to get into all the numbers. Again, you can read through the chart yourself, but one just kind of overarching concept is that, or I shouldn't even say concept, I should say fact, is both our imports and exports are getting more expensive. and that's kind of why we are seeing, what you're seeing at the pump, what you're seeing at, grocery stores. It's all based on the import-export, which is, pretty self-explanatory, but it does go to kind of outline it at least in numerical values, right? So we rose 0.6% in May after advancing 0.4% in April. So again, more so just to give you guys a high-level view of where this stuff is kind of numerically pushed towards, and just to give you some context of how these data actually gets released. Now, the second item that I want to bring us to in regards to some of these economic reports is retail sales numbers. So we got that this week, and just to kind of highlight what I'm looking at is this retail trade sales. They were down 0.4% from April 2022. They were up 6.9% from last year. Now that's pretty self-explanatory due to COVID. But just focusing on this 0.4% down. Now these are monthly numbers, but we're not seeing a huge decrease in most of these retail sales numbers. Are you're not going to see a 10% month-over-month change by any means, unless you're talking about the first month of COVID. But it is important to see that inflation really is starting to impact consumers, and so when you're seeing the retail trade sales go down, people are not buying on inelastic goods. Maybe the cars, the additional clothing, etc., that they might not need. So this is kind of a good little indicator of where we could be going. Right when this starts going down is typically when you're going to start seeing additional markets starting to suffer. So keep an eye on this, guys. This is important. And I did want to, just before we move on from this one, quickly highlight exactly the kind of factors that played into this. You have the auto, and general merchandise. So that's a big one that you want to look at. So just kind of, if you're interested in these, you can find them at census.gov. This report came out on June 15th. So again, last week there was a lot that came flooding into us. But, just kind of think through these. The next one's going to be July 15th, but this really just plays into our overall market thesis and kind of where we think things might be going, and it dictates how we think through our swing trades. In this case, right, when you're thinking about, okay, what's the next 2 to 3 weeks look like for a particular trade? If you have a bunch of headwinds, i.e., declining monthly sales that you just understood come from this report, you might kind of ease that back or change your timeline, impact your stop loss. So we'll talk about how that actually has a material impact, but let's move on. So the next report I quickly want to talk through is the Empire State Manufacturing Survey. This is another big one that just got released again last week. Now what this does is just kind of goes through quote-unquote overall business conditions. It'll go through current indicators, new orders, shipments, etc., etc. So you can kind of go through this, and this is just released by the New York Fed. But one thing that I think is important to quickly highlight is the change from May to June. Now we are down still, which is obviously never good, but we're not down in the sense it's not a larger decline, I should say. So that is a little bit of a writing, something to be kind of optimistic about. That these declines aren't increasing, so they're not getting, the delta isn't getting larger, but we're still definitely not out of the woods by any means. And you're starting to see a large drop in unfulfilled orders. That's never good. Delivery time is actually decreasing. Now I don't know if that's derived directly from just people ordering less. So there's less stuff that actually goes out, right? So if you have 1 million things going out and now you have 800,000, right? You can expect the delivery time to decrease. But it's important to look at these reports, guys. It gives you a really good overall sense of where we are, and this is kind of like what you could call the real economy. and what actually is happening and where trends are moving. So just go through this at your own leisure, but this is a good one to always quickly check in on each month. Now, rates have been getting a lot of attention this week, and obviously just for the Fed meeting on Wednesday, the 75 bip increase is obviously going to impact yields overall. But I do want to talk through where we are in the yield curve, what that means in terms of an inversion, and just kind of the overall spreads that we're looking at. So here's the 10-year and 1-year spread. Typically, most people don't really use the 10 and 1. It's more of 10 and 2. And this report actually has the 10 and 2 down here, but you see the 10 and 1 inching towards 0, so that's like a flattening of the yield curve is what they call that. And then an inverted yield curve is when that spread kind of flips, if you will, right? So you start looking at the 1 month, 1 year, 2 year, 10-year, and 30-year. Most people are typically looking at the 10 and 2, and that one is down here, right? So the historical 10-year and the 2-year spread. So what it's saying is that the spread between the 10-year and the 2-year is getting tighter and tighter. And I think we actually had a day of inversion, and then it slightly popped back up. Yeah, I don't think this ever inverted. But this is kind of like a economic indicator that a lot of people look at. And there's, the 10 and 2 isn't the best one. You can do like the 18-month and, the 1 year, the 3-month, and the 18-month is a kind of one that people usually point to as well. But the 10 and 2 is a great one, and something that is definitely worth paying attention to. Now, just so everybody understands clearly what this is, if you look at the 30-year yield, what this is saying in 30 years, the yield you get over that time is going to be 3.282. In 10 years, it's going to be 3.231. Now, these are as of 6/17, so this is as of last week. I'm currently recording this Sunday, but what it's saying is that investors are needing to be paid a premium to invest in the 10-year, meaning that there's economic uncertainty in the near future, so investors are going to require more compensation for their capital, right? So if we just think about it, a really small time frame, like let's just call it like a one week rate or 1 week yield, and a 1 month yield, right? So if you're again, just kind of a silly example, but if you are a lemonade stand and you have your own yield curve and rates for your business, and they're expecting a bunch of weather, a tornado coming, and you're not going to be able to produce any sort of you're not going to have any sales just because it's going to be bad weather, and you're not going to be out on the side of the road or wherever your lemonade stand is. So over the week term, you're going to have a lot higher of a yield. But then in the month term, you'd assume that there wouldn't be rain, tornadoes, and bad weather for a month straight. So that rate on the 1 month would be a little bit lower. So that's kind of how you can think about it, a 1 week to a 1 month versus a 10-year to a 30-year, 2-year, 10-year, etc., etc. So it's essentially just saying that the 2-year/1 year is being risk rated higher than something like the 10 and 30. And so it's important to pay attention to. I hope that made sense. It was kind of a analogy I just made up on the fly, but maybe not the best one, but hopefully it conveyed my point. So just quickly, guys, let's point to what we're going to be seeing next week. Again, the market is going to be closed in honor of Juneteenth on Monday, June 20th. So short week. We don't have any, it's not as busy as a week as it was last week. We have a lot of finalized numbers. Pay attention there. I do like looking at these new home sales. That's important. And then the big one that will be streamed, and I'm sure we'll get a lot of eyeballs, is going to be this meeting that Jerome Powell has with the House Financial Services Committee. So it's just going to be one of those kind of him answering questions, everybody grilling him. So it should be interesting. But we'll see what comes out of that. I don't anticipate too much volatility around that. He usually has really well prepared comments. Policy aside, he usually doesn't come unprepared. So I don't think we'll have any kind of bombshell news coming out of that. But stay tuned. So moving away from our economic reports, we'll get into the fun stuff here in the markets. And what we are seeing, NASDAQ continues to sell off, another rough week. But I wanted to show you where we currently are standing. And this is a weekly view. And if you look at our 210-day moving average, I like the 210. A lot of people use the 200. I find the 200. Everybody uses it, so I kind of try to move it a little bit. But just my overall thought process. For overall market, we are seeing on the weekly that is getting down to about where you saw it at COVID levels in terms of total drawdown. But again, we have potentially a lot more room to run, guys. So be super careful here. And just make sure that you understand you're not going to have a huge capitulation, I'd imagine, like you did during COVID. This is, in my eyes, a lot more akin to the 2001 sort of bubble, where you had this prolonged months and years of downturn before we really started seeing any sort of appreciation. So just be mindful of where we are in this overall market scheme. And I showed this chart ad nauseum, but I think it is good to always reiterate. This is the 2001, so going to 5,000 to 1,000, right? Huge drawdown. And you see all these little bounces, right? I'll draw them on here for you. You see, bounce, 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 bounce. So just be mindful. We could very well have a green week this upcoming week where we're up, 5%. But just be very mindful of where we are in the cycle and how long a trade like this can take to really occur before you start seeing true turnaround. So just be careful, guys. I do want to also highlight gold, which was kind of curious this week. You'd think something like GDX, which is just kind of like a gold miners ETF, and we can look at spot as well, but just for more simplistic terms, GDX has a little bit more trading volume, so it's easier to look at. But let's bump over to the 4-hour. We saw a pretty major sell-off. Now, for all you gold bugs out there, you'd say, well, why are we having a sell-off when gold, metals, etc., would be a quote-unquote inflation hedge, right? We're seeing increased inflation, but we're seeing gold go down. It just doesn't make a lot of sense. Now, there's kind of two ways to think through this, and it's helpful for me to talk through this because I'm still forming my own opinions as well. The first lens is that, okay, this is going to be a rush to liquidity. You're seeing a lot of margin calls start to happen. You're seeing a lot of funds get liquidated. Just like we saw in March 2020, people are running to cash, which is, if we flip over to our dollar index, it's still holding pretty strong. Apologies for that. Yeah, if we flip over to our dollar index up here, it's still holding pretty strong. We're at 104. Came down a little bit from its highs, or at 105.78, but we're still holding strong. So the dollar is holding strong. So what that is saying is the rest of the world still views the dollar as a strong storeholder of value and wealth. My thesis a couple years ago was that you're going to start seeing the dollar really trade, negatively. So you're going to see a real large drawdown. You could see it get to 80, 90, at least on the DXY and kind of how it's measured here. But that hasn't been happening, which has been pretty curious to me. And so we have a strong dollar right now. So that's something to take into consideration. But flipping back over to GDX, so that rush to liquidity, rush to dollars, right, for the reasons we just outlined, right, there's still a lot of the world, viewing the dollar as a strong reserve currency and that it doesn't have any sort of potential for failure or anything like that, right? It's all very low there. So regardless, when you're in a liquidity type event like we saw in March 2020, you're going to see a sell-off in pretty much all assets and a rush to the dollar. So I think that could be what's happening here. Now, the other side of the coin is that, hey, the Fed's very hawkish here, and actually inflation is going to be coming down. So gold, in theory, is going to be selling off because the market sees inflation is coming down, right? So that's probably both happening. Now, depending on what side of the aisle you fall on, you might view it through a different lens, but that's kind of my thought process behind why we're seeing this movement in gold. So moving over to our free picks for this week, the first on our list is TWI, and in a bear market or in a market with extreme headwinds, we really want to focus on trying to always find these trades that still have some positive momentum behind it. Now, obviously, these things can change on a dime, but that's why you always have your stop losses, right? So always keep your stop losses tight. Don't get overextended, and just live to fight another day, right? Now, in terms of where we think this might be going, we're really just hoping for a kind of a quick little bounce, maybe a 4 to 5% trade here. I wouldn't try to play this, up to the 20s by any means. But if you look over on the right side of my screen, you did see a pretty large sell-off to end the week. So we're really going to need to bounce back from there, and then keep going. Hopefully with some positive market news that things are trading a little bit better this coming week. But be mindful of these guys. As I mentioned, in a bear market, don't overextend yourself. Have a bunch of quick little wins and keep those stop losses tight. Second trade that I like here is DDS. That's Dillard's. And again, we're kind of trying to play this off our moving averages. We're starting to see a little bit of a kind of rounding top, maybe some consolidation that we don't like. But we did have some good support as we broke through, bounced back up. Now that's good to see. We are testing coming back to these levels, so I'm hoping we're going to be able to bounce off this 180-day moving average. Now if we don't, we might be falling to the 200, 210, but just keep that in mind and adjust these as needed. Now if we get a turnaround on Monday and we start shooting up to the 278, 279 range, that's probably when I start putting in a play. And see where I put my target price in at 312.40, 312.50, 60, somewhere around there. What I'm looking for is I don't want to try to time this and get back to this level of resistance up here. I'm much more comfortable with just riding, a 6 to 7% trade, because you see these large capitulations, right? These huge candles. We want to avoid that, right? So let's just try to play this up, don't overextend ourselves, and go with our trends. As I was just flipping through some of these other trades, I wanted to quickly highlight why we do have always a target price. And this is Obsidian Energy. This is a energy company that the club played probably about a month ago now, as you see with this little kind of winning box. Now, yes, you could have played it for a pretty substantial gain, up about 40% or so, give or take a bit. But guys, it's super important that you do close these positions and have an understanding of where you want to get to with each trade, because you have these huge capitulations that it won't just keep going up forever. You're going to have a drawdown, a mean reversion is what they typically call it, where it goes back to moving averages, and it kind of essentially, as I mentioned, goes back to the mean, goes back to the averages, reverts back to where it normally trades in a typical range. So just be mindful. That's why we have these target prices, so we don't overextend ourselves, ride it all the way up, and then ride it all the way back down. That's not good for anybody, which is very akin to what's kind of happening in crypto, right? You had this huge uptick to 68,000, 69,000, whatever it got to, and now we're at 19, 20,000. So just be super careful, guys, and I just kind of wanted to add that in as a little bonus for you. So I think we'll close it with that. I'm hoping everybody learned a little bit about where the spreads are for the for our treasuries right now. I'm hoping everyone has a little bit more insight now on what the Fed funds rate actually does, where that movement is happening, some other economic indicators that we talked through. Definitely appreciate if you stuck along me with this far. It's gonna be a long journey in terms of kind of getting this to where I want it to be. Just from an audience perspective, from me becoming more articulate, giving you guys better value. But I appreciate everybody and talk to you soon. I lied. One last thing, and I'm not very good at self-promotion here, but if anybody is interested in joining our actual swing trading club, we have a Discord that we run, and this is how you get this sort of conversation day to day versus just once a week. We have a group chat of about, I think right now it's sitting about 480. Usually hovers about 480 to 500 as people come and go. But we have a good group of individuals from different, really all walks of life. Honestly, we have international folks. We have a lot of different people that make up the group. So it's a good to kind of bounce your ideas off. So if anybody is interested, we have a lifetime pricing. We're charging $220 at the current moment. We have monthly. Obviously, lifetime's a lot better deal when we want you to sign up for life. And then we do offer a free newsletter that goes out weekly as well. That just outlines the picks in a little bit more detail. We do offer discounts, so just reach out to me via email or Instagram or comment or whatever. I'm pretty easy to get a hold of, and we can get you that squared away. And this is really a big kind of driver for me, so I appreciate it, and we'll talk to you soon.